What up, investors? It's February 23rd, and today I'm going to go over Q4 2022 earnings breakdown for DraftKings, symbol DKNG. This is a big important part of our portfolio. We own this stock. We've owned it for a while, and we've added significantly, more than doubling our position on the way down as it's been sold off in 2022, okay? But right now, our position's pretty set. I don't see us adding any more until we get to the low, maybe 15s or under 15, 14 range. We'll go over all that, okay? But before we do, please hit that like button, hit subscribe. Hopefully you learn something from these videos and we have some fun in the meantime. Let's get into it. So here we go. For those that don't remember or haven't seen the prior videos, and I'll put a link there to my prior DraftKings video. The business segments for DraftKings, pretty simple. We'll start with the mobile sportsbook, okay? The mobile sportsbook comprised of two parts. We got the daily fantasy. That's mostly for NFL and NBA. There's other components as well, MLB, NHL. I don't think those are as successful, let's say, as the NFL and the NBA. I think the daily fantasy, the king is going to be the National Football League. It's going to be the king of daily fantasy. And then the sportsbook, that's where you can bet on games, bet on the over-under, bet parlays, bet on weird things during the Super Bowl, like who's going to throw the first flag or who's going to score the first defensive touchdown, things like that, right? And then we have the online casino, which is where you play casino games online. You have roulette, poker, blackjack, all kinds of games, and they're all outlined on their website. And then the NFT marketplace, my least favorite part of the business now that NFTs are sort of like a joke, essentially. But I've always said that if you're going to make NFTs a thing, I think that the most viable, more sort of value creating, I guess what I'm trying to say, most value creative NFT could be an NFT of a professional sports player, the same way that somebody would hold a Tom Brady, a Peyton Manning, trading card or a rookie card that holds value and gains value over time. I can see how an NFT of a Tiger Woods, let's say, could gain value over time with sports fanatics, okay? And with the NFT marketplace, it's not just about trading and buying NFTs. It's about using them as currency to make bets, okay? So it's a little bit of a sneaky way for them to encourage more gambling through their app, through NFTs. So it's not necessarily that they're buying monkey NFTs or some panda NFTs. It's actually they're actually NFTs with a purpose of increasing the top line and bottom line, okay? Now, smaller parts of the business, gaming software services, media advertisement, and sponsorships as well. Okay, those are not big parts of the business. These are the big dogs here of the business, the sportsbook and the online casino, right? Moving on. And of course, I always try to say, hey, if you're going to talk about the stock, show the skin in the game, or say, I don't own it. I'm just talking about my opinion on a stock that I don't own, but I do have skin in the game to the tune of $8,568, okay? Our position is down currently by 17%. Totally fine, totally okay. Our cost basis is $10,339 or $22.98 per share. So we're down in the position. I don't think we're down that much at all, and the route and the performance of the company shows me that it's going to be worth a lot more than that. This is the daily move from today. Not a big deal. Totally fine sticking with it at this point. Now let's go over the numbers. Okay, so we start with the EPS. That's earnings per share. On a GAAP basis, a loss of 53 cents per share. This is a money-losing company. No secrets about that at all. It's always been a money-losing company, but it beat the expectation over 58 cents loss expected. So they reported a less of a loss than expected. That is a beat in a day of the week. And then we got revenues at $855 million versus $799 expected. That's over $55 million in revenue expected. That's a solid beat as well. And a nice raise in guidance. That's the big beat. That's the big triple beat for earnings. Okay, we raised fiscal year 2023 guidance from 285 to 305 by about $50 million more than the street expected. And the EBITDA again, earnings before interest, depreciation, tax, and amortization. It's actually, I think I might have misspelled that. I think it's EBITDA, but whatever. You get what I'm saying, okay? And they raised it by about $25 million more than the street expected, and positive EBITDA by fiscal year 2024. Very important. That's a very important revenue raise or guide, or I'm sorry, EBITDA raise for positive EBITDA for 2024. Okay, and moving on. Talking a little about the investment thesis here, because it's very important that we understand why we own the stock. Okay, so we have an excellent business model with brand recognition. Okay, so we have a business that, yes, losing money, but it is trending in the right direction, and there is sure brand recognition. DraftKings is maybe number one or number two best recognized sports betting app. You have others like BetMGM, Caesars Sportsbook. We also have the FanDuel, whatever you want to call it. Those apps are there, but they're not as recognized as DraftKings, especially in the fantasy side of the equation. Okay, so we have strong balance sheet with high double-digit revenue growth. We're talking about 81% revenue growth year over year. Very strong revenue growth and a strong balance sheet with zero debt. Essentially, they do have a little bit of debt, very small compared to their cash position. So very strong balance sheet, A-grade balance sheet on a to F rating. Okay, TAM, total addressable market. I often talk about total addressable market in stocks. It doesn't mean that the company's going to be worth whatever management says. You always hear numbers like, oh, our TAM is like 3 trillion, 2 trillion, right? Yeah, the size of the market, but you're not going to capture all that. That's just impossible to do, especially in a highly competitive environment like mobile betting or mobile gambling, which DraftKings is in, obviously. So they've only realized about half the revenue from the United States. And remember, we're just talking United States, not all over the world. These guys are in Canada, in some England, parts of England where they can gamble on soccer. But at the end of the day, in the U.S., that's where the big money is made. They've only realized about half their revenue potential, essentially, okay? Now, number one most downloaded sportsbook app in the U.S. since the Super Bowl and in many other parts of the year. It just depends on seasonality, right? Sports aren't all year round, but there's different sports and different fan bases all around. I think the next big thing, we're talking March Madness, is the next big thing that's coming up. And then they just released the only in-house same game parlay offer for NBA. So this is a little bit of differentiator. Pretty nice to know that they're differentiating themselves in their offerings from other businesses doing the same thing. They also have a strong online casino offering, which enhances cross-selling. Okay, so it's a little bit of a difficult explanation with cross-selling here, because you also have the capability of cannibalization of a customer, right? So when I talk about cross-selling, is it's very easy for somebody to go gamble with their sports book login and then move into the online casino when sports are not around, maybe during an off season. Maybe if you're a football fan and it's March or April, maybe you're going to the online casino and you're waiting for the NFL season. Or if you're a hockey fan and during the hockey offseason, you do the same thing. But the cannibalization side of this equation, which is, I would say it's a negative, is that if your players keep losing, they're not coming back to you. If they keep winning, they're going to stay there. So it's a little cannibalization. We don't want winners to stay winning on the app as investors, right? We want a healthy amount of wins and losses, right? Or losses and a little bit of wins just to keep you interested. I'm from Vegas, so I know how that game is played, okay? So strong user trends in retention, handle per player, and hold rate, okay? So this essentially speaks to, hey, retention, when a user enters the app, it's harder and harder for them to leave it because of those cross-selling opportunities, because of the value proposition, because of the deals they have with the NFL, NHL, NBA, to have replays, to watch these games, and to make the best of the app and actually have fun within the app. So it's harder and harder to leave. Okay, you also have free cash that they give you when you sign up. Of course, I've never signed up to that because I live in Nevada. DraftKings not allowed in Nevada. But if I lived in another state, I would get like $200 for free to start gambling there and to start playing around with the app and actually help that be a retaining tool for me as a player to keep me in that app. Okay, and we're talking about handle per player. That's the amount of money they're spending, keeping on the app, and hold rate, how much money they're holding on the app. Okay, so we're also talking about serious commitment to cost controls and marketing efficiently. This is management saying, hey, we're serious about controlling costs and being efficient with our marketing. The marketing part, not so much yet. This is what they're telling us. Hey, we're serious about it. Okay. And that depends on the state rollouts that they do, because remember, they're not active in every state. They're only active in about half the U.S. at the moment, or a little bit under half the U.S. Okay. But cost controls, when it comes to SG&A, their administrative and corporate costs, doing a very good job of controlling that. That's already evident in the income statement. We'll go over that in a little bit. And then smart management team, which knows how to execute, and execute they are. We'll go over that on the statement, okay? And then a little bonus here. After earnings, we had some upgrades. Piper Sandler, Morgan Stanley, Jefferies, and BTIG increasing and upgrading their ratings of these stocks to overweight. Overweight just means, hey, it's going to outperform the markets. Buy ratings, of course, very self-explanatory what a buy rating is, as opposed to a hold or sell rating from these analysts, these Wall Street experts. Now, as always, there are risks associated with every stock, and I want to kind of bring that a little bit more to life, because it's not all happy rainbows and unicorns and everything's going to be great with DraftKings. There are serious risks to these stocks. This is a little bit of a riskier stock for me, but like I said, I like the business, I like where it's going, and I'm willing to wait for that profitability, and I know its path. But at the same time, we have to consider the risk, okay? And one of the biggest risks that we have here is legislation, regulation, and taxation, okay? The biggest of those three is legislation, okay? So when DraftKings is out there, they're spending a lot of money in lobbying legislatures, state legislatures, congressmen, senators into allowing their product into new states so they can open the doors and go in there, spend marketing dollars, set up operations, which is expensive, and deploy their product, okay? And we'll talk a little bit about how that works, because that's a very important equation to DraftKings, okay? Regulation, if there's new regulation that outlaws online gambling or some sort of, religious limitation or some sort of other moral limitation to gambling, and here in Vegas we don't have many of those, but in other states you could, then you have a problem, right? And taxation, high tax rates, states that go, yeah, you can come in at a high tax rate, that's a problem as well, okay? Now, fierce competition, this is not a very high moat, right? A moat is, what competitive edge do they have? And I say the competitive edge they have is their brand and their applications. Their applications are better and have better reviews than your FanDuels or your MGM Bet or whatever other little mom and pop app that pops up. Here in Nevada, there's one that sort of like looks kind of silly. Nothing to do with DraftKings, of course. DraftKings, or they can't hold a candle to DraftKings, but there is competition out there with all sorts of different companies that offer online sportsbook and online gambling. Okay, now there's also the path to profitability. Hard to understand the path to profitability because DraftKings is not one business, one sort of linear line to profitability. Each state is almost like its own little DraftKings business with its own things to consider, right? Pluses and minuses to consider. You can have great states like Arizona or New Jersey, right? Or even in Ohio, but you can have expensive states like Massachusetts where establishing operations there just started and it's expensive and there's a lot of marketing deployment to get your product out there to folks' phones. Okay, so that's something to consider there. Sports contracts with the NFL and the NBA. These guys are fickle. In the NFL and the NBA, all they want is money. They just want your money. But DraftKings is like the number one official app. You'll hear like official sponsored app or official app. It's like official partner. That's what you hear with DraftKings, are the official partner of the NFL, in which you can watch live replays, which you can't do in other apps, and also watch the game live with that app. That's another plus to DraftKings with the NFL. I don't know about the NBA because I'm not an NBA fan, but I know with the NFL you can watch live games on the DraftKings app, okay? And then as far as the stock, it's a price to sales valuation, okay? And when we talk price to sales, stocks that are priced on price to sales, also price to revenue, you could say, are more pricey than a price to earnings stock in which a company actually has earnings to measure. This stock has no earnings to measure, so it is based on a price to sales valuation, okay? Very important to understand that price to sales valuations are way more risky than price to earnings valuations. And now, expensive to expand in other states. We talked about a little bit, like Massachusetts. They just opened that and they're throwing a horde of cash into these states to make them profitable, okay? And heavy cash burn to the tune of 40% in 2022 goes to the same tune. Spending money to set up operations in new states costs a lot of money, and to keep people engaged costs a lot of money. Every time you see, for example, in the Super Bowl, the commercial, right, that says, "Hey, get DraftKings, and we'll give you $200 in free play." That's customer acquisition costs. Those are always and have always been high, and that's money that comes out directly out of DraftKings' pocket. That's something they have to correct, and that's huge cash burn. But at the same time, it costs money to acquire a client. For any business, these guys are just putting it all up front and hoping for back-end rewards later, okay? And then seasonality, very obvious seasonality. Every sports fan is different. They have an off season. Maybe you have sports fans that watch everything. That's not me. I'm more of a Formula One, NFL, and maybe some soccer when the World Cup is on. That's about it. That's me, okay? And then stock-based compensation. This is a stock-based compensation heavy business, okay? It's incentivizing employees to come to the business with heavy stock benefit packages that make share dilution, dilute shareholders like myself, and make the my slices of the entire pie smaller and smaller as new employees come in and more stock-based compensation is given. And as an added bonus to the risk factor of the stock, okay, we got risk of reduction of consumer discretionary spending given the high rates and QT. We're talking Federal Reserve, guys. We're talking about that over and over again, okay? As liquidity is pumped out of the economy, there's less cash out there for consumer discretionary type businesses. So that's definitely a risk there. And then the casino winner-loser fallacy, we talk about that. We want people to win, not a lot, but we also don't want them to lose every time that they just go away and never come back. That's a dangerous balance, a hard balance to strike for a company like DraftKings and many other casinos and gambling type products. So moving on, we talked about Q4 revenue, $855 million. That's the 81% revenue growth that we talked about. Very, very strong revenue growth. Amazing, okay? And adjusted EBITDA, don't care about that at the moment. We want net income, not adjusted EBITDA, so don't care about that too much. They raised the guidance. We talked about that. 18 out of 19 states contribution profit was positive, okay? So it means the trends are getting better in these states, okay? For full year 2022, it's expected to grow from 105 in full year 2022 to greater than 500 million this year. Very important metric. So that's a really, really good trend to the upside as far as these positive contribution profits, okay? And then fixed expense growth is expected to slow meaningfully in fiscal year 2023 and decelerate further in fiscal year 2024. Costs control, that's exactly what we're talking about, okay? And then 1.3 billion of cash, and expect to have greater than 700 million on December 31st of 23, and expect a positive adjusted EBITDA in fiscal year 2024. Good, but again, properly spelled EBITDA. Not too crazy about EBITDA, especially because of the depreciation factor of it. Not too crazy about it. We want net income, actual positive EPS per share on a GAAP basis. That's what we're talking about. Now, moving on here, we got another pretty important metric. One of the most important metrics of the business is how to guide, essentially, or get the weather report as to how the business is doing and how it's improving. Okay, we're talking about MUPs and RMUPs. Okay, monthly unique players and average revenue per monthly unique player. Okay, and we're talking MUPs in 2021 at 2 million monthly unique players. 2022, that increased to 2.6 monthly unique players. That's very strong growth. And then the RMUP, $77 per monthly unique player to 109 in 2022. That is very, very positive, and it shows that the business is trending positively towards that EBITDA guide that they gave us, which is great. Now, another very important metric that they're showing us here is contribution or profit contribution of the 2018 2019 states. These are the states, or the contribution of states that they opened or they initiated business in 2018 to 2019, and they're saying, hey, we're still seeing 50% revenue growth from those states, adjusted gross margin increase of greater than 400 basis points, greater than 50% year-over-year external marketing decline, okay, and increased contribution profit from those states, okay. And this here, straight from the call, Jason Robbins, the CEO, saying, we're seeing great customer retention, handle for retained players growing, promotional reinvestment is coming down, right, and hold percentage is going up. And because much of the net revenue growth is coming from less promotions and higher hold, our adjusted gross margin rate in that vintage is this time, was up more than 400 basis points in 2022 versus 2021. And he goes on to answer a question during the question and answer session of the conference call. And he says, if you unpack the 50% revenue growth right here that were experienced in that 2019 vintage, probably 70% was from existing customers, and call it 20 to 30% was from new customers. Very important, right? States from 2019 or 2018 still see new customers. So the point is, even though those states were in their third or fourth year, we're still acquiring new customers. So we haven't found a ceiling yet in those customers. Those states are still growing customers. Very, very important metric to look at, and very important detail to understand about these states, that the growth has not been capped yet. It'll be interesting to see where does that growth cap, especially when it's 50% year-over-year revenue growth. I'd be very interested to see that. Now, I want to point out something really quick on the income statement to move on here and show you guys some pretty good details about the income statement. I'll put this here in black, okay? And then we'll look at the revenue growth on the 3-month ended, okay, and year ended. We'll separate these two here. Year ended is all this. We'll look at the 3 months ended just to keep it simple. Revenue up significantly higher. Amazing, okay? But the worrying parts of the revenue statements are cost of revenues, sales and marketing, and product technology. We're still increasing spend here. This is all positive, increased spend on those three items, okay? But general administrative, that's also called SG&A, going down. That's a good trend on both metrics, okay? And then interest income here, that's a pretty good metric here as far as increase. I'm thinking this is probably some high yield savings, CDs, some bonds that they're getting more income from. That's pretty good improvement here as far as a 3-month ended year over year. And then here we got some stock-based compensation. That is one of the things that I hate to see in these income statements, and it's a dilution factor. It's a tool to retain employees and to hire new employees. I get it, but it dilutes us shareholders, and we do not like stock-based compensation. Okay, so if you want some shares, buy them. Don't give them away. Okay, but here we see that it is improving. It's a metric that is getting better, still to the tune of 130 million. Don't like it, but improving nonetheless. Okay, and then we have some transaction-related costs also here that are getting less, and litigation costs that are getting better as well, on both a full year metric and on a 3-month basis. Okay, now a couple of things here to talk about just before we close out. Okay, we had the 81% revenue growth that was outlined in the income statement, but also on the call. They launched the DraftKings jackpot and progressive share jackpot. They received approval for the first live casino game, which was 100% in-house development, and they've identified over $100 million in cost savings for 2023. That's good. We're trending in the right direction. We're seeing faster paths to positive profit contribution from active states. We talked about that, old to new, okay? They teased the investor day for some new long-term profit outlook, okay? Let's keep an eye on that investor day, when it's going to happen. I don't think it's there on the investor relations side. I didn't find it. If you found it, let me know, and let me know when that is, but we'll be tracking that for sure. Okay, marketing spend will be about flat year over year. Don't like that. It should go lower. But at the end of the day, you got to spend money to make money. These guys know what they're doing. I think they had a pretty good handle on their spend. the World Cup was not any way sort of meaningful to their top or bottom line. They talked about the Disney relationship being great. Very important here as far as Disney, I think. There's a lot of rumors, a lot of market anticipation going around because Disney just split or they changed the way they reported their business segments, and they separated out that ESPN into its own reporting segment. And there's a lot of speculation out there as to Disney and DraftKings doing something for sports gambling. So I wouldn't be surprised if Disney makes some sort of acquisition attempt towards DraftKings or some sort of partnership, something there with Disney. There's a lot of market rumor speculation going there. I wouldn't mind that happens. I would rather not. I think this business can do well on its own in the long term. But if it happens, it happens, and we'll benefit from that accordingly. And I think it's something that would be very beneficial on the short term for shareholders, okay? And then no current interest in taking out debt to finance growth. That's good. That's a disciplined approach. Enough cash on the balance sheet to be aggressive if necessary. I like that they said that very clearly. If we have to be aggressive, we will, but we don't feel like we have to be aggressive, okay? And then the mergers and acquisition, M&A, mergers and acquisition environment is difficult, but if the right deal arises and the share price is higher, then maybe they can use some stock to make some strategic acquisitions, okay? I don't like these kinds of acquisitions that are all stock acquisitions because it's really hard to kind of calculate the dilution factor of that and how combining two groups of shares or several groups of shares dilutes a current shareholder. Really hard to do that. Hopefully they don't do that, okay? And then they'll start, keyword, start looking for expansion into international markets in 2023. I wouldn't expect them to actually deploy anywhere in 2023, maybe a late 2024, 2025 deal, but we'll wait for that, okay? Now, just want to give you my purchase points, and I'm done, okay? So under $23 a share, I'm okay starting a position there. Under 18, you augment it slightly. 14 is your conviction buys, and 12 is load the boat on DraftKings stock, okay? So if you guys have any questions about anything that we talked about, hopefully it helped you understand DraftKings a little bit more. If I got anything wrong, if you have any suggestions, if you need any help, please reach out to me here on YouTube. Hit me up on Twitter, Instagram, the Discord chat. I'll put a link below. Peace out.